Welcome to System Trader Podcast. Listen to interviews with top traders and find out how the most successful traders beat the markets and what are the secrets of their success. This is System Trader Podcast with your host, Jack Lempart.
Although he didn't know too much about the British pound fundamentals or economy, he made a bunch of money at the same time when George Soros was shorting it. How he did it? Was it pure luck? No. My guest believes that big trends happen in the markets. And when it happens, he just needs to squeeze it like a lemon. No complex entry-exit signals, no fancy charting. He puts, however, a great focus on risk management. At the same time, he's very patient and strategic. He doesn't have to be profitable every day, every week, or even every month. But all he does is carefully planned, and in the long run, his trading approach is very, very profitable. For decades. After all, he was featured in Jack Schwager's Market Wizard book in 1992, for a good reason. In 2003, he happily retired at the age of 51 years, and today, he's still actively trading on his private account, using the same old methodology, trend following. If you haven't yet guessed, yes, Tom Basso is on my show today. Enjoy the ride. Hello, Tom.
Hello.
Thank you very much for accepting my invitation to the show. It's really a great pleasure and honor to have you here today, Tom. I have plenty of questions from my podcast listeners, which I merged with my questions so that the list is more structured. So let's get started. From what I know, your background is chemical engineering, which seems to be, at first sight, quite far from what trading is. Could you please tell us a bit about yourself, how it happened that you became a trader?
Well, I did start as a chemical engineer. Before that, I started as a paper boy and delivered papers, and I worked in a grocery store. But eventually got through college. Chemical engineering was my degree, and I actually designed chemical plants for about 5 years. And another 3 years or 4 years, I worked in the business side, marketing research on the industrial side, which is studying your competitors and dealing with competitive strategies for the chemical factory. And then I also moved into strategic planning for a very short period of time before starting up a money management business. During all of that time, I realized that because chemical engineering was very cyclical back in the 80s and 70s, there was a tendency for every 4 years the economy would have a boom and they'd hire chemical engineers, and then they'd have a bust and they'd lay off chemical engineers. And I thought it would make a lot of sense to have a portfolio or some money behind me saved so that I could scramble and find another job or do something different. So as a protection to myself, given the cyclical nature of the economy, I started a portfolio, and that led to needing to know what to do with the portfolio. So I started talking to a lot of people that were other engineers and found a couple of guys that we started Kennedy Capital back in the old days. I was one of the 3 founding partners of that, and it was primarily a stock firm. And we grew our assets under management on a part-time basis. We actually were doing this and working full-time. And I was getting an MBA at the time, and I was doing a lot of things, and very busy guy back in my 20s. And I got the portfolio to the size where we could afford one of my other partners, and then finally the third partner, and then we were full-time. Eventually, I sold my shares of that a few years later and formed Trendstat Capital. And Trendstat Capital is more the epitome of a chemical engineer's view of managing money, because what I did was, in chemical engineering, to do a simple example, you would have, say, water coming into a tank by a pipeline. You'd process that water inside the tank maybe, and then you'd ship out the final product to a rail car, to a pipeline, whatever. So you think of input, process, output. And isn't that what money management's all about? You have data coming in over the satellite through various data feeds, downloads from various databases. You process that. In other words, you take all that information and you try to figure out, what do you want to do with that information? Do you want to buy, sell, do nothing, move a stop, whatever it is? and then you have to output the orders, the cancel and replaces, and find your equity run misprints and things that where traders have bought instead of sold and whatever. In other words, you output information and decision making. So to me, the money management business just became my view of a chemical factory. And so my degree actually was well suited to what I ended up doing at Trendstat.
Okay, that's a very great story. Thank you, Tom, for that. What was the maximum level of assets under management at Trendstat?
We got up to just at right about $600 million.
Wow. And how many people worked at Trendstat?
There was only 10 of us at the peak and about 40 computers.
Okay. But as far as I know, you just decided to shut down at some point Trendstat. Mm-hmm. So you actually retired being still very, very young. So what was the main reason you have decided to shut it down?
Well, I had a 28-year run, and what happened actually, true story, I was in Bermuda for a currency conference. And because I had been 28 years in the industry, I had lots and lots of friends and people who knew me and, market wizards, new market wizards and all that, only increased my visibility, I guess, to the industry. And I was 50 years old, and I walk into this conference, and I'm used to walking into these places and getting my badges and signing in and all that, and having, 3 or 4 people come over to me and say, "Hi, Tom, I haven't seen you in a while. How you doing? Blah, blah, blah." Well, I walked into this place, and there was a whole bunch of 20-somethings and 30-somethings. In other words, a lot of young kids. And I looked around the room, and I didn't see a single person I recognized at 50 years old. And I thought, this is interesting, so let's see how this works out. And so I spent the whole weekend going to various talks and giving a talk that I had to do or be on a panel of some sort that I was on. And I finished that up, and I got on the plane and went home, and I thought, there was almost nobody at this conference that I grew up with or came up in the business with. They've all gone. They've all retired, or they've committed suicide, or they're in alcohol rehab or whatever. And I said, there's a whole lot of things in life that I would rather be doing than just grinding out this, bringing in data and processing it and shipping out orders and dealing with employees and all that stuff. And I just have a lot of interests. I'm not a one-dimensional guy. So I thought, I'm not making that much money from this. I really don't need the money at this point. Why am I doing it? And so I just decided to give my clients about a 5-month, I think it was, warning that they should find other managers to handle their assets. And I gave my employees a similar amount of time and stable through the end elected to do. So we closed down and had a party at the last day, and my employees found other jobs and went off and did different things, some in the same industry, some in different industries, but for the most part they've been pretty successful. And I've happily retired, so it's getting on 15 years now. And I have been absolutely happy with the decision, enjoying life and doing a lot of great things, both for charities and for just managing my own portfolio, doing a little research myself, keeping up with emails, building a website actually that I'm going to go live with for maybe another month or 2. So a lot of fun. Yeah.
So now you're just enjoying your retirement, Tom.
I am. I'm a poster child for retirement, actually.
I will return to the topic of how to happily retire, because this is also very interesting. But before that, I have a couple of questions, let's say more technical. The fact that you are on the market for like 4 decades and you're still trading is exceptional achievement to me. I mean, how would you describe your market edge? What is it?
It's probably changed over time, I would say, but In the early stages, it might have been to be able to process more information quicker and more logically than the average investor or trader. Because I had a lot of computers behind me, and I was one of the early adopters of using computers and programming and so on to do systematic trading. And as black boxes became more prevalent and you had all the Wall Street crowd jump on AI and all that stuff, then I think some of that early advantage probably disappeared. I mean, they have faster computers and more closer proximity to where the orders have to go. They can split in microseconds, do stuff that might take me a second, and that's enough to get ahead of me on everything. So now, all of a sudden, some of my advantages start disappearing. But what I find with a longer-term approach is that my edge is that I'm patient and I'm strategic, and I find so many investors so caught up in the noise of the market and what's happening in the last hour, and I don't even look at the market all day. I mean, I pretty much do my work at the end of the day and ignore all the nonsense. So when people get that way, an edge for me, it's very hard for a lot of people to be that strategic and to be that, stay with your strategy and have the discipline to do it. And so that becomes something of an edge in the later years here, I think.
Okay, thank you. So why have you decided to become a systematic trader? I mean, apart from these technical aspects, rather than, for example, a discretionary trader? Okay.
To me, if you go back to my history again, and I think I mentioned that, looking at about 1980 or so, and I'm starting up a lot of these money management things, and I'm doing computer programming with our first IBM PC, which came out in 1980. I think before that we had a TRS-80 from Radio Shack. It was very minimal. What I had to do, when I made a decision to do something, I wanted to be able to track why I made that decision, and to then, at the end of it, the trade, to go back and be able to say, could I have done this better somehow? And I needed data to do that, and I did everything with a calculator, by hand, on sheets of paper and chart paper. It was very cumbersome. Some weekends, in St. Louis, if it was raining, I might spend all day Saturday and all day Sunday doing nothing but poring over this stuff and doing it all by hand. And I simply thought, that's way, way too much time in my life. I have other things I'd rather be doing than sitting there pounding a calculator. So when computers came in, what I tried to do was to just put myself out of business, basically, to try to take this little task that is easily computerizable and say, all right, I'll do this amount of stuff over here on the calculator, but I want to do that little block of things on the computer. And I'd get that done, and it would relieve a few minutes of my day. And then I'd say, okay, well then, how about this over here? I'm doing this by the calculator. Why don't I program that, and I'll attach it to this first module, and now I've got two things I don't have to do every day. And little by little, I just asked myself, how do I get from the data coming in to the orders going out, and how do I make that all one large set of blocks that get it all done? And then I don't have to do anything but to go in, fire the program up, get the data down, and ship out the orders, and I'm done. That relieved huge amounts of my time, allowing me then more time to do research, to think about things, to think, what am I doing that could be improved? What's working well? What isn't working well? How can I, create some stats to dissect what I'm doing to see if I can figure out a better way? If you're just trading all day, you're discretionary trading, your eyes are glued to the screen and you're trying to make decisions. You don't have any time in the day to actually step back from it all and think about things. And I think that's been very helpful in my development over the years.
Okay, thank you for that. Because I quite often see, for example, on the internet, people saying that algorithmic trading cannot work because the markets are too complicated, let's say, to describe them within a simple formula. But I see that you see this differently, that the markets are not that complex, so that it's not possible to, let's say, encapsulate them within a simple code.
Yeah, I think a lot of people, being human beings, I think there's a human tendency to want to know why something happens. So the stock market is up 100 points on the Dow today, let's say. Why is it up 100 points? And my attitude is I don't really care. It's up 100 points. If I'm long, I'm making money. I don't need any more than that to understand what's going on. So if you take price as the ultimate dependent variable of all of the millions and millions of traders out there and all the algorithms that are fighting each other, buying, selling, and there's literally billions of shares trading out there over the course of the day. Each person buying and selling thinks they're making a decision that's in their benefit. For whatever reason, one person's an economist, the next person sees a chart breakout, the next person's using AI, next person has some kind of a moving average. All of those people think they're making the decision that they want to make. And each of them is exerting his or her own influence on the price of that stock or that index or whatever it is. If I just measure that final dependent variable, the price, then it's encapsulating everything that everybody else is doing, and all I got to do is worry about the price. And that simplifies everything in my mind. It's more buying than selling, driving prices up. It's more selling than buying, driving prices down. I don't try to get more cerebral than that about it.
Right. You have appeared in a well-known Jack Schwager'a book, The New Market Wizards from 1992. So now, in 2018, 26 years later, how your trading approach is different? How you as a trader are different?
Well, I would say as a trader, I'm more mature and more, you get to the point where there's a bit of wisdom after you've seen so many ups and so many downs, and you've been through a lot of drawdowns, and you've been through a lot of periods where you've had great success. And you've seen bull markets and bear markets, and you've seen choppy sideways markets, and you've seen scores and scores of different political structures in the U.S. at least that you've had to live under. So you kind of have a little bit more of a long-term strategic sense of things. Trading approach would be different, probably mostly because as I was managing other people's monies, I had to be sensitive, or at least I felt it was my job to be sensitive to what the investors could tolerate on risk and could tolerate on returns, and what types of things they were going to let me do for them so that they would actually let me manage their money. In other words, you coach, and many people have, that seems brilliant on the surface, that tests out unbelievably well. But if you go out and try to market that to your average insurance company or bank trust department or wherever, some well-known, wealthy individual, they would look at you like you're crazy. They're not going to let you do that for them. There's other things that you could do that would be very super conservative and wouldn't produce much of a return. They're not going to let you do that either. So part of the problem of being a money manager is to come up with an approach that's sellable enough to investors. It is sound from the standpoint of you being a trader and you're a fan of it, but that it's packaged in a way that is sellable. In the case of now, I don't have to sell anything. I have 2 accounts for my wife, 2 accounts for me, and life is good. I don't have to concern myself whatsoever with track records. I don't have to concern myself with what instruments I'm trading. I have no legal status anymore. I've retired from my registered investment advisory license. My commodity trading advisor's license is gone. Retired from that. I'm not even doing arbitrations anymore. I'm purely retired from the standpoint of the money management industry. And that allows me to do what I want to do for me and for my wife. And I think our risk tolerances are probably higher than the average investor out there. So I'd say my approach is a little bit more risky now, but my approach is also far more strategic in that I don't really care what my monthly track record is this month, because I'm more strategic and what I'm doing fits what I want to have done. So everything is perfect. You know, when you finally get as a trader to matching what you're doing with who you are, your capabilities, your resources, your skill levels, and all that stuff, that's going to optimize your ability to be the best trader you can be. And that's where I am right now. I'm doing exactly what I want to do for me. And a lot of people ask me, what do you do? How come you do this and whatever? And I tell them all that they should be doing what I did, which is to create their own personalized trading strategy that fits who they are, their assets, their skill levels, everything. That's how you get successful in trading, not trying to trade like somebody else who you're not.
Right. And there's now a bit easier in the way that there's no one who will fire you if you will have a bigger drawdown. So you don't have to be worried about this. You can just trade as you want.
Exactly, and I don't have any government agencies coming in and reviewing my books,
right,
which the last year of Trendstat, before I closed it down, I figured was around $100,000 US in 2003 dollars, which were spent a lot better than 2018 dollars. And that $100,000 did absolutely nothing for my clients or for me. All it did was tie up my time, waste the people, the government agents that came in, did their work, they got paid. They were in there out of a 52-week year. I probably had close to 4 weeks or so of IRS, SEC, or investment advisory side. It eventually got to be the state of Arizona, who didn't know what they were doing. And then we had the NFA, National Futures Association, would come in and spend a bunch of time. It seemed to me at that stage of my life, 28 years in the business, I was doing more to explain to them how to actually review my firm and teaching them what questions they should be asking me and then answering those questions than I was doing any good to, answer an audit question. I mean, these people just really 6 months out of school, and I'm trading foreign exchange, I'm trading 80 different commodity markets and futures markets, and I'm trading about 20-something mutual funds, and I'm doing it all within one company. And most of these people had no idea what currency trading was. They didn't even know what a Forex trade would look like or what the paperwork flow would be. So I'm having to teach them vast quantities of information. Nobody's paying me to do that. It just got old after a while. It wasn't serving anybody any purpose.
What is your current approach to trading? Is it still mostly based around a trend following concept?
Yes, trend following to me makes the most sense in that you have periods of time where supply and demand of positions, whether I have to say positions because I trade futures, I trade stocks, I trade a lot of stuff. To me, when something's in balance, the prices are probably not going to move up or down. Well, if you look at where profits come from, and I did these studies and published them back many, many years ago, if you look at all the major firms in the futures industry, and then you took the top 20 volume markets in the futures industry, and you measured the movement of those markets up or down, didn't make any difference, versus the profits that flowed to those top 20 or so money managers, the periods of time where there was a lot of price movement were the same periods of time where those managers in general made their biggest profits. Now, if you then translate that into the fact that trend following does nothing more than try to pick up on any moves that are significant, then what you're doing is matching yourself to the markets and picking up all the major moves that a market makes That's where you make your profit. The rest of the time, you just keep doing what you're doing and probably sit there and either lose a small amount of money or make a small amount of money, break even basically. You're trying to key your profits to those large price movements. Trend following is exactly that. That's why it fits me so perfectly.
Okay, I understand. And what time frames, for example, daily, weekly bars, you mostly use in your strategies?
I use daily bars. I figure once a day is not too burdensome for me to spend 20 minutes looking at my portfolios and running some of my the code that we have that helps make decisions in some of the markets. I can sit down usually sometime in the afternoon after the market's closed. Sometimes it's after dinner if the day involves a golf outing like it did yesterday. I didn't get my work done till 9 o'clock at night because I was gone all afternoon playing golf, and then I had a dinner following that. So it just depends on the day. Sometimes I'll run it right at 1 o'clock when the markets close here in Phoenix, and other times it'll be 9 o'clock at night. So, but sometime usually before the markets open the next day. And what I do is try to use all the data that comes in for that day, add it to the previous database that I've got on that particular market, depending on what strategy exactly I'm doing and for what exact market I'm doing it, and get that all run and get the orders shipped out to wherever they got to be shipped, or leave the orders the same if there's nothing to change.
Okay, thank you. How long on average you have your positions opened? I know that being a trend follower, especially the long-term trend follower, you would like to have a scenario where the market is going to the moon, but on average, how long your positions are opened?
Well, it would depend by the markets, I suppose. In futures area, an average successful position, if you don't include rolling it, which has to happen when things run out of their expiration dates. If I just say that that's one continuous transaction, I'll have transactions that could run almost a year. And those would be rare, but they would be very profitable. And there's lots of transactions on the losing side where I'm closing it out within a week or two.
Okay.
On the stock side, I've held some positions now for years.
Wow.
My hedge trades, which are used to hedge the stock portfolio. So in other words, I own a bunch of long stocks and I throw short sales on the S&P 500 using the SPY ETFs. And if I do that, I would say most of my hedging trades don't last, or at least haven't lasted in the last many years because of the bull market. They rarely make it past 3-4 weeks probably on average.
Okay, that's interesting what you mentioned about this hedging. So basically, instead of closing the positions on the stocks, if you are long, you are basically hedging, selling the wide market. So you are still keeping your positions. Could you please elaborate a bit more on this?
Sure. The reason you do it is largely for tax purposes and to have better liquidity. In other words, if you're going to go into a stock and say it's an $8 little stock that trades 500,000 shares a day. So you have to establish a position in that stock. It's not like I'm trading all of the stock. It's not like I'm trying to acquire the company or anything. I'm just trying to be an investor in the company. But once I get in there, if I try to get out of there real quick, I'm going to have a hard time trying to get the market to give me a fills that are reasonable. I'll start moving the market around or putting pressure on it or having to work hard to get out of that particular stock. And in addition to that, in the U.S. at least, there's an advantage to having a long-term gain versus a short-term gain, tax-wise.
Right.
Or at least there used to be. And I'm not even sure. I haven't even done my taxes for this last year, so I don't even know how the new tax law changes over here have affected it, but we'll figure that out in the next month or two. Bottom line, though, is I don't want to try to do a lot of trading in stocks. I want to own positions that are good businesses for the long run, and I don't want to be buying and selling them. It takes a lot of time, and I want to do other things in retirement. However, I see the market as something that drives what those stocks that I own do. They actually are going to go up and down a lot, with the S&P going up and down a lot. So why not go ahead and use something based on the S&P to take away a lot of the market risk of, say, a 50% down market, which in retirement would not be a fun time for me. I would rather, have a conservative portfolio that is protected from risk as much as possible, because I don't want to have to go back into business and start trying to, trade people's money again. And so what I try to do is just to hedge myself and make sure that if a market is going to collapse and go down 50%, which I think is very realistically possible and has happened in the past many times, I'm not going to lose that 50%. I'm going to lose a whole lot less than that, because my hedges are going to make a lot of money to offset the losses in my stock portfolio.
I understand. But all these decisions are made via your algorithm, systematic way? Or,
sure.
So there's no discretion approach at all?
I suppose you could argue that in some cases, if I have 2 or 3 choices to buy a specific stock for my portfolio, I probably use some discretion to kind of look at the business models of each of these and say, what makes most sense for the long term to hold this position for a long, what kind of business would I think is a little bit more of a diversification for my portfolio and makes the most sense from a business standpoint. But that's about it.
Okay, thank you. And currently, when you trade on your private account, what is your, let's say, goal in terms of yearly profit and risk?
I don't have a specific number. I would say somewhere between 5 to 10% for profits, and on risk side, maybe something similar to that. I'm not looking to, crank out 100% returns or anything like that.
Okay, I understand. But are you using the same strategy still which you used at Trendstat? I mean, I'm asking this question because I'm just wondering how you see how market changes over time. Do you think that a sound trading strategy, like some trend following strategy, may work on the market for, let's say, even decades? Or do you maybe have to fix them, tune them, or even maybe completely replace them by new one?
Well, perhaps a little bit of both. If you look at what I'm doing now on the future side, that was exactly the same types of things that we were doing at Trendstat back in the day for clients, with the exception of I have it geared up a little bit more in risk and volatility. So my position sizes for the same amount of money are a little bit higher than they would have been for clients back in the Trendstat days. So it's virtually identical math.
Okay.
In the stock side, that is completely redesigned and created strictly for my retirement. I've never used that strategies like that before at Trendstat ever. Okay. So it's a little bit of both.
But do you have to spend a lot of time on the research part still?
No, I don't. If I have an idea that comes to me either through a question that I get, and I get emails from all around the world every day, it seems, asking questions. Sometimes somebody will ask me a question and make me think of something. Then I might say, that might be something interesting to look at. I wonder if I could research that, and I'll go and do some work. But most of the time, I have what I'm doing to fit me, and I don't have clients that I have to try to sell something to, or regulators that I have to provide a lot of information to. So there's no need for me to do that kind of research anymore. So I strictly work on research projects that intrigue me for my money, not to try to do something for, the industry or for other money managers or government or something like that.
Okay, thank you, Tom. As you are a trend follower, I need to ask you, how can you tell the market is trending?
Okay, well, There's probably about 1,000 ways to do that, and I encourage every trader out there always to find his or her own approach that makes sense. But the simplest thing to understand in an example would be a simple moving average. So if you have a moving average and you have, say, let's do a 10-day moving average versus a 50-day moving average. The 10-day is going to move faster, and therefore when it crosses to the upside, the 50 moving average, you're going to have an indication that the trend over that short run is up compared to a longer term stable average. That would be a simple, easy to understand example. If it moved to the downside, that would indicate that it's in a down direction. So if you just did nothing more than buying on every break up and selling at every break down, you would always pick up every major move of a market up or down. You would never ever miss it.
Okay.
The negative would be is that, of course, in sideways markets, you would get some buy signals, sell signals, buy signals, sell signals, and you would whipsaw yourself many, many times. So there's all sorts of other ways. There's point and figure breakouts and breakdowns. There are, I use for my hedging, I use Keltner bands. Those are volatility-based bands above the market and below the market. When it breaks the upper one, you buy. When it breaks the lower one, you sell. So in my case, when I break the lower one, I put the hedge on. When I break the upper one, I take the hedge off. But that's just the way I understand Keltner bands, the way I'm trying to hedge infrequently, but with enough sensitivity to protect my portfolio. That's why it's designed the way it is. It's why it's designed over 20 days, because that's the timing that I want with it. That may be useful for some person, or they might want a 10-day Keltner band, or they may want a 50-day Keltner band. By designing what you do for yourself, you have the ability to make things more active, less active, a little bit more risk, less risk. You can dial it in wherever you want. And that's why I always encourage people not to try to... It's interesting, I suppose, for a lot of people to know what I do, but I worry that if they're trying to copy it, I'd be thinking to myself, why are they doing that? That's stupid. You know, it's not... The average person in Brussels is not Tom Basso sitting in Phoenix. Different time zones, different markets, different everything.
Yeah.
Knowledge levels, risk tolerances, the amount of dollars I'm managing. Some people send me an email and say they're trading $5,000. I don't even know how they do that. It's kind of not enough money to do very much. I mean, there's ways to do it, but you're really limiting yourself. So what I encourage people to do is to take the knowledge of what's available out there, and there's certain things that you need to do to create a trading strategy that makes sense. And I've been shooting a video series for the new website that gets into all the different aspects of how to create a personalized trading strategy that fits the person, not Tom Basso.
Right.
And I hope I'll find out in about a month or two. But to me, that's what it's all about for trading success, is creating something that works for you, that has an edge that you can understand, that you're comfortable with, that you will be able to survive that drawdown that invariably happens, and test your patience. When you understand it and you've got a trading approach that fits you, you just laugh at the drawdown. You say, well, yeah, that markets are doing this and my strategy is that, and I should have a drawdown now. Nothing's broken, don't fix it. Just keep doing what you're doing.
Yeah, thank you, Tom, for that. I mean, it's like, I know that you are saying that the entering the market is not the most critical part of trading, but on the other hand, this is in opposition to many, especially young traders, who are looking, let's say, for their holy grail, and they are just fully focused on finding the most efficient way how to enter the market, whereas this is not what you do.
You probably heard about the random
test
I heard that I did.
Yes. Could you please maybe say a few phrases about this? Because it's very interesting.
It's basically exactly why I tell people to buy or sell is one part of the very small part of the trading strategy. You have to know when to buy and sell, but more important than that, you have to know how much to buy or sell. That's actually more important. And then even more important than that is the mental side of you having the discipline and the time commitment and everything that you need to actually pull off the first two. Right. If you're all screwed up mentally, and you decide, even if you're a systematic trader, I've seen systematic traders do this. They have a big program, they've spent a year building the thing, it tells them to buy X, Y, Z, and they say, I don't think I'm going to do that, I don't feel comfortable doing that. So what was the point of all their work? That doesn't make any sense to me. If you're going to do that amount of work, and you believe in the work, then you need to have the discipline and the mental side, and that's hard. It's one of the advantages I have, having done it for 40 years. It's, making a trade in a stock to me is about as easy as breathing. I don't even think about breathing, and I don't think about buying and selling a stock. I've done it so many times, it just doesn't push my buttons. It doesn't make me excited. It doesn't get me nervous. There's absolutely no emotional impact. And I think that, when you traded this long, that's where you get to. But the new trader finds that they're like gamblers. They think buying this stock, this is going to be their big payday, and they're all excited. And I was that way when I was in my 20s. That's exactly what I was. I did that. Once an hour, I'd call up my commodity broker and ask how the commodity markets are moving and seeing whether we're making money or losing money. And nowadays I don't even look at it until the end of the day. And I trade far more dollars now and far more positions now than I did back when I was all a basket case over, trading simple things. So the key is it's not entry and exit only. There's what markets do you trade? Let's say, for an example, like lately I've made a bunch of money on lumber. Lumber had a big run up and a big run down now, and it's still short so far. All right, so I've made all this money on lumber. Why did I make the money? Because I was disciplined enough to buy it when it was supposed to be bought, sold it out and went short, made it all the way down again. I don't look at lumber all day long. It's just doing what it normally does over a course of time. There will be times where I'll lose money on lumber. That doesn't bother me either. And I think what you do is, but the fact that if you weren't trading lumber, you would not see that big up or that big down. Right. So if that's not in your portfolio, so that's a major decision is, what are you going to trade? Because if you don't pick lumber, you aren't going to have those profits. If you do pick lumber, you are going to have those profits. So the decision to put lumber in your portfolio was a very important thing. More than that, how much of lumber? Do you buy 1 contract, 2 contracts, 6 contracts, 10 contracts? That's going to affect how fast the equity curve goes up and down. It's going to affect your ability to be a stable emotional state, because if you buy too much of it, you're going to find yourself getting too excited when you're making money or too distraught when you're losing money. And it makes your mental side of trading harder on you. You're going to worry about diversification. So lumber may or may not move in the same direction as, say, the stock market or whatever. But probably lumber doesn't care what live hogs is doing. Those are probably two different things. So diversification is an issue. Time is an issue. How much time can you spend going through? Can you do 80 markets? That's a lot of work. I'm trading probably around 20 markets right now in futures. That's easy for me. I've got it all automated. It doesn't take me more than, 5-10 minutes to do all of them and have it. It's all automated. And that's fine, but it's taken a lot of work for me to get to that point where I can take 20 minutes. It's hours and hours and hours, weeks and months of work and money, paying people to do some software programming and so on to get to the place where I am right now. But once you're there, then why not trade it? That's important to have a broad spectrum of things outside of just buying and selling. Because the random study I did said, if you put good money management behind your decision making to buy and sell and just use a random number generator to either buy or sell on the open the next day, if you're out of a position, trail your stops, keep moving them up, manage your size, you show a slight propensity to make a profit. Slight. You wouldn't want to trade that as a strategy. I'm not suggesting people go out and flip coins. But it speaks to the lack of importance that people put on buying and selling. There's far more, good things to be had by sizing your positions properly, worrying about your portfolio and what you're going to trade, managing your risk, all those things. Those are far more important to your long-term success than whether you bought or sold.
You mentioned that you are trading many markets, so to be well diversified, although we know that there are moments when the correlation coefficient is at the level +1 or -1, so basically there is no diversification. We either lose or we either win on all positions. But
absolutely.
I just wanted to ask you a question because especially young traders, they are very much interested now about trading the cryptocurrencies. What do you think about this market, this young market?
Well, that's what I think. Well, to speak back with your +1, -1, we had a term at Trendstat that we invented ourselves so that we could talk about this concept of +1, -1 correlation. We called it lockstep. In other words, all the markets are in lockstep with all the other markets. If one market goes up and the other one's going down, and then when the first market goes down, the next one goes up. And so no matter what they do, they're correlated either -1, +1, and then we call that lockstep. In the case of cryptocurrencies, you've got a market that I think is rather young. For those who want to play in that game, that's fine. I really don't see something. I mean, I look at it from my viewpoint, not from a new trader starting out or a trader trying to deal with clients. I think that would be a very difficult market to try to convince clients to go into. I think it might be something that could be useful for a small trader that wants to try to get into that space, understand what's going on, and maybe try to build a portfolio. It's just not something for me for a retirement situation. I don't see it. I do see, by the way, that the digital world will take us over. I think cryptocurrencies long term, and as they become a more mature market, will be a viable way of transferring money back and forth for goods and services. It's just more convenient to do things in the digital world than it is with physical paper.
So there's future for the cryptocurrency world.
Yeah, I think there is. I think they just got to figure it out. I don't even know how many of them now. Last I heard, there's hundreds of various people throwing out various cryptocurrency concepts. Yeah. And there's a few of the bigger ones, and then there's a lot of lesser ones that nobody's heard of and are not doing very much. What's going to happen, in my mind, you're going to have some disaster stories with the embezzlement schemes that have happened already, where people have lost, millions trying. Somebody stole the cryptocurrency. There's going to be a lot of those types of problems to work out and gain the trust of the market and the general public before it can become a more mature trading vehicle. I mean, if you look at futures, I've got the NFA and the CFTC behind everything that I'm doing, and the exchanges actually, behind all those futures positions. So I've got some people looking at what is going on with the trading to keep it honest and to keep money backing those positions. In cryptocurrencies, it's a little bit more of a Wild West rodeo. You kind of wonder whether it'll be there the next day.
Right. And how about the Forex market? I mean, if you are trading currencies, is it via the futures contracts? Or?
Well, yeah, in Trendstat days, I definitely, to get the size and the liquidity, we traded foreign exchange. So we had about 14 different trading desks, big banks all around the world that we did business with. And that was the way we could move the $600 million. Most of it was in currencies. And these days, because I'm just a couple portfolios for myself and my wife, I use futures contracts. It's just easier.
Okay, I understand. Thank you. You said that your trading is your process is automated. Does it also mean that your orders are executed automatically, or you transmit them manually? I mean, because if you are a trend follower, then basically you don't have to interact during the day. It's enough
Correct.
for you, as you said, to do something at the end of the day. So do you do this in an automatic fashion? As well?
All my orders, with the exception of a purchase of a stock, which sometimes I have to manually move into the position because the volume is not sufficient to allow me to take the entire position for all 4 portfolios that I trade in the stock area, all at one trade. I have to physically, okay, I'm buying 5,000 here and I'm buying another 5,000 and I'm going over to this portfolio and doing 500 and I'm working it and getting the position put into place. That would require manual work on my part, so usually I'll log off about a half an hour or an hour that day. The day looks good. I've got nothing on my calendar, no interviews with anybody from around the world. And I'll sit there and I'll just enjoy myself at the computer, seeing if I can find a new position and move into it. Other than that, all my trades are generated by a computer, and then I hit a button to send them to good to cancel stop losses or stop buys or stop sells. Those are put in to the brokers. They're sitting there all day long when the markets are open. I don't have to be there.
Okay, thank you. Now I have a pretty big question, because I would like to ask you, what is your approach to the development process when you build trading strategy? Okay, you said that you are not spending so much time now on researching, but if you would have to just give a few steps, maybe if you have such steps defined, what is the process of development?
All right, well, the first thing I recommend doing is doing an assessment of yourself as the trader. You're going to have a certain amount of money to trade. You're going to have a certain skill set. Like you had mentioned that you are coming from the software side of the industry and working still in software and various high-tech area. So that gives you a skill set that maybe the small businessman that wants to get into trading, who's never ever programmed a single computer program in his life, you've got different skill sets. You've got different educational backgrounds. You might have taken computer science and have a degree in it, or you may have just barely made it through high school and you became a hacker and you wanted to get into more software development, and you did it that way. Different degrees, different skill levels, time commitment. Maybe one guy is working a full-time job and trying to trade on the side. Another guy wants to trade full-time 10 hours a day. Different time commitment. All of those things, when you go through and take an inventory of everything about yourself, that's going to help give you the answer of what your trading strategy should look like. Because if you don't fit that trading strategy to all of what you just inventoried, then you're going to be at odds with yourself to try to pull it off. And either you're not going to have enough time. If you're working full-time, for instance, and you wanted to day trade, how are you going to do that? You're working full-time and then you're going to miss trades and you're going to be stressed out. It's not going to work. You're going to fail 100% of the time. So that's the first thing. The next thing, once you've now developed sort of this overall strategy of, okay, it looks like I'm going to be able to trade maybe once a day, and I got to limit myself to no more than 1 hour of work, and because I've got family and I've got, a girlfriend or whatever, I've got different things, time is going to be pulling me, I'm studying for an MBA. that 1 hour has got to be a disciplined 1 hour. I mean, it's got to be every day, over and over again. Can you do that? Once you get that, now you're starting to get into how long a trading strategy do you want to have. If you're making decisions once a day, like I do, I like once a month type of or month's worth of data. There's about 20 days in a month. 20 days for me fits me. That's about the amount of period of time that I want to say that this month, 1 is different than that month, number 2 is different than that month, number 3. I don't want to be getting into this day it did this and the next day it did that and try to make huge, profound statements over it. So that leads me to kind of the time aspect. Now you're starting to get closer to buy-sell decision. I want to be a trend follower because I want to pick up big moves and I want to ignore small ones. So now I've got the whole tier of trend following indicators to select from. Which one do I want to use? Well, let's look at them and just play with them and try to understand the math behind them and try to decide, does this fit how I see the markets reacting to information, or is it foreign to me and I don't even understand the math? You want to be able to understand exactly how it's making its decisions to buy and to sell, and have those decisions match your own. If you want volatility adjustment, fine. If you don't want it, fine. You got all sorts of different indicators you can use that will give you something close to what you believe the market does. Next, you have to deal with size of your portfolio. How many positions are you going to select to put in the portfolio, and what are they? In other words, are you going to trade lumber or not? Orange juice or not? Soybeans or not? You're going to trade treasury bonds or not? You're going to build your portfolio. You're going to look about diversification. You're then going to decide how much of each of those things are you going to buy or sell when you buy or sell them. The more you buy, the faster the portfolio goes, the more leverage you have, the more money you can make or lose. Makes it more difficult. I would recommend people start as small as they possibly can get away with, just so they have trading experience. You can always up your risk levels later, but at first just get used to buying and selling and realizing how it all works. Lastly, portfolio issues. When your risk of your whole portfolio gets very large because all your positions have gone in your direction, do you want to peel some of that back off? There's ways of doing things like that. There's a great book that Tharpa wrote that is pretty technical, but I like it from the standpoint of what it addresses. And it's called Tharpa's Comprehensive Guide to Position Sizing.
I know this. Very good indeed. I can recommend.
That is an awesome book uncovering so many topics involved in position sizing. Read it and wade through it, and in some cases it might put you to sleep at night if you're having a trouble going to sleep. But it's highly technical. It is a lot of good stuff in there. If you can wade through that, you'll know everything you need to know about position sizing. And some of the stuff in the book was some of the things that I taught Tharpa from my Trendstat days. So there's some of Tom Basso in that book. He has all my blessings to put it in the book. I think the more people we help learn about position sizing, the more I've helped the trading industry, and it's fine with me if he uses that stuff. It doesn't bother me at all. But he's added some things that I didn't do in Trendstat days from that he talked to, things that he's come up with himself, and then he's got some of Trendstat's approaches and all blended into one book. So it's pretty good read. Yeah.
It's very opening the eyes.
But does that give you a flow? I mean, now, and then I guess last but not least is the execution side of it. We've gone through an inventory on ourselves. We have buy and sell. We've decided on our portfolio. We've decided how much to buy. We've decided what to do with the total portfolio if it gets very risky or not risky enough, and into a drawdown or not into a drawdown, all the different things you can do with a total portfolio. And then finally, how do you get this thing done every single day, without exception, on vacations, when you're sick, when your wife is having an issue that you have to deal with, all the different things that go on in life, you have to have that all mentally prepared for and part of your trading strategy.
Okay, so not to
and
miss.
Then you're ready to trade.
Right. Because I remember once you were talking about missing a big move on the silver, if I'm correct.
Mm-hmm.
So this is what you're talking about. So
exactly.
You never know when your trade will be profitable or not. So therefore you have to take all of them.
Yep, you have to take all of them. That's part of your strategy. And if you skip one, you are reducing the sample size of the data that you're using to trade from. So if you look at the next trade you do as the next single trade in the next 1,000 trades that you're going to be doing to create a nice database of trades, you don't know whether that one trade is going to be the biggest profit of the year or the biggest loser of the year, or just a nothing burger, and you end up wasting your time for 2-3 weeks and you're out of it and nothing happens. You have no idea. At least I don't. I wish I did. That would make it a lot easier, wouldn't it? But no, some of my best trades in my life that I remember just offhand were trades that when I got into them, I thought, whoa, this is going to be interesting. I'm not so sure. And it ends up going crazy on you, and you end up making a lot of money. You just don't know. And the more you get your own cerebral mind out of it and use your cerebral mind to develop your trading strategy and your risk controls and your position sizing, that's where your human brain can be brilliant and come up with something that's useful. The actual executions, like I said, you don't think about taking your next breath. I don't think of taking my next breath. I just breathe. And trading's the same way. The execution side of it should be just about as easy as breathing.
And now, short break for our sponsor of the show, Candle Scanner. Candle Scanner is a technical analysis software package created for investors interested in candle patterns. What makes Candle Scanner application exceptional is that, from the outset, it has been specifically designed for the detection of candle patterns. It is not just an add-on to an existing analysis platform, but a specialist charting application written by people with an extensive knowledge of the topic of candlestick patterns. It is suitable for both seasoned traders and complete beginners. With Candle Scanner, you can do the following. Quickly scan candlestick charts to find all occurrences of candle patterns. Measure the efficiency of patterns, that is, are they working as you expect them to? Build trading strategies based on candle patterns and simulate transactions. And soon, define any custom pattern you want, then scan the charts and measure its efficiency. And all this without any coding. Please visit candlescanner.com for more details.
And how much data, how many years of data you need for when you are developing your strategy? Actually, how you backtest the strategy as well? Because I know that you are focusing very much on understanding how the strategy works. So therefore, because there are very complex approaches to testing, backtesting, and so on. And people are coming up with very complex processes sometimes. Whereas I see that you are rather going in the direction where you know how the strategy really works, when it should work, when it shouldn't work. So how do you backtest it, and how much data you need?
Okay, let's go ahead and use the moving average example again. And let's say I'm going to take once a day trading. What I would like to see at a minimum, not necessarily a maximum, a minimum, I would like to see an extensive sideways period in that market that I was looking at, a very large up move, and a very large down move. And I would like to see how the simulation acted during all three of those time periods. And I would like to see it on a day-by-day basis so that I knew how it reacted to more volatile markets and more quiet markets. And once I've decided that it is capturing those parts of the market that I feel it should capture, In other words, creating a profit when the market is moving upward significantly, or avoiding losses on the downside, or even making a profit on the downside if its strategy involves a selling short type of strategy of some sort, or hedging. What I'm trying to get to is then in the sideways markets, it probably is lost money. All right, I'm not against losing money if it's supposed to be that way. If you're trend following and you have a sideways market, you're probably whipsawing yourself. You're losing money. So I'm trying to match what I think it should do during the period to what it actually seems to simulate out. Then I'm comfortable with it. And however much time it takes to encapsulate an up market, a down market, and a sideways market would minimally give me a good feel for what that strategy is going to do in the future in those types of markets. Then the question is, do we think the markets are going to be any different over the next 20 years? Yeah, maybe more automation, maybe whatever, but there's going to be up markets, down markets, and sideways markets. They've been that way forever, and I don't see any reason why it would change. We're not going to just have sideways markets for the rest of history, the rest of the future. And we're not going to just always go up, and we're not always, we haven't eliminated down markets. We're going to have some down markets in the future. So given that we think that the future is going to have some mix of the types of things we've had in the past, and given that I know how the strategy reacts to those situations, I'm comfortable with it. That's all I need. I don't need to go back 50 years and crunch data forever and then just look at the final results and say, oh, it made money over the last 50 years, so I guess it's good, let's go. That wouldn't do anything for me because I don't understand how the strategy reacted to various time periods. And that's going to be harder for me to be comfortable with it as a black box to suffer through a drawdown and realize, yeah, that's normal. It should be doing a drawdown now because it's a sideways market.
Understand. Thank you very much for that, Tom. I have a bit more complex question from one of my listeners, so let me explain it first. There is a measure expressed as the number of so-called degrees of freedom, which is typically equal to the number of trades minus the number of rules and conditions of the strategy. And some believe that this number is related to how tightly the strategy fits the data. So the more degrees of freedom, the less likely it is that the strategy will be overfit.
Yes.
Are you maybe using this concept in your trading? I mean, are you maybe calculating how many degrees of freedom your specific strategy has, or you don't use it so explicitly?
Yeah, I actually did do some of that work, and Jack Schwager'a was the one that I have to credit gave me the ideas on degrees of freedom. When he talked about that at some Market Wizards panel that I was on with him, I thought, yeah, that makes a lot of sense. And I actually did some amounts of research and study on degrees of freedoms, and I found that a simple example, let's say you start with the moving average example again, that's your buy and sell. But then you notice that whenever the, let's say ADX, some kind of a momentum indicator, is not positive, or directional moving index, a DMI, a directional movement index, whenever that's positive and you get a signal, then you get a better reliability. And then you notice, yeah, if I could actually then also track the S&P 500 on a 50-day to 200-day moving average, and if it's positive, then I get a different reliability, and that looks good. And you start adding more and more, and pretty soon you got 10 different indicators that all have to agree with each other for you to get a buy signal. Well, you're not going to get a whole lot of buy signals. So what ends up happening is those 1,000 trades that you have to do in the same time period that I might be doing 1,000 trades, you might be doing 25. So you have a very, very small statistical sample, and it takes the rest of your life to get to 1,000.
Yeah.
So you are really trading in a very small statistical space that doesn't give you the reliability of of what you think it's giving you, because you're looking at, you're limiting it down so much that you're losing the statistical probability of having your success. So I always am now slanting what I do as much as possible to the smallest amount of degrees of restriction, I call it, as possible. Degrees of restriction from the standpoint of, let's see, I got to have this filter work and that filter, and I got to have that moving average, and I got to do this one, the Keltner bands, and I got to have a breakout on the point and figure chart. And those are all degrees of restriction. They're restricting you from doing the trade. And the less of that you do, the closer you get to your own, the more you can build a good statistical sample size of trades, the more you can have reliability with your strategy.
Okay, very, very interesting. Thank you very much for that, Tom. I have a few, let's say, various questions from my listeners, and one of them is, have you ever, during your career, shared some part of the trading capital with other traders and let them trade independently?
No.
Okay.
And I should add, why would I not do that? It's because, let's put it this way, not with Trendstat. During my career as a retired investor, I have had some other traders manage some money for me. And even today, I have one trader that is managing some money for me. And the reason I do that is because I know that this specific trader is doing something that I have no desire to try to do myself, but it is diversifying for my total portfolio. Does that make sense?
Yes, it does.
So it saves me time. I'll pay them to do what they do. It fits my portfolio perfectly. I know that they're doing what they're doing because I track it daily, and I can see that they're doing what they're supposed to be doing. And as soon as they start doing something different from that, they'll be fired. And that's fine. That saves me some time and gives me a different return stream in my total portfolio. But for the most part, when I was actually at Trendstat days, we had, I don't know, 8 or 10 different strategies, ranging from trading options on futures to several strategies on foreign exchange trading. We've had 80 markets trading 4 or 5 strategies on futures. We had mutual fund timing by a couple of different strategies. There was a lot going on in there. And each one has its own return streams and problems and instruments. And that to me was a better way to control it than to have somebody outside of Trendstat that I couldn't see what they were doing or trading. That didn't make sense.
Yeah. Okay. Thank you very much. I've got another question. What tools do you use for your trading? I mean, software, brokers, data?
Well, I try to keep it simple in retirement. So on the broker side, I use Schwab for my stock and securities trading. Why? Because they are a nice combination of a strong size of firm with a reasonable amount of access to computerized data, computerized indicators, and research on the actual stock positions. So that's easy. Interactive brokers on my future side is very automated, very good at what they do. They don't give you a lot of help necessarily, human help. You have to kind of know what you're trying to do and get in there and do it. They're not going to hold your hand at all, but just for a raw execution capability and getting the job done, they do a good job. Interactivebrokers.com. And then for data, I use a CSI typically for anything that I'm doing on a research basis. That seems to be a reasonable compromise of lots of different things, but that's where I've gotten some data for research.
Okay, and this is mostly the daily quotes, right?
Yes, exactly. And for daily updates for data, I use Interactive Brokers data, and I link to that, and they will actually offload the historical data for that day to you. If you work through the problems of doing that, you have to figure that out, but yeah, they can do it. And then for software, I've been using Trading Blocks, BLOX, Trading Blocks.
Yes, I know
out
it.
Of Boston, I think is where he's located, and Tim Arnold's the guy's name. Smart guy, nice platform. It's flexible with respect to being able to customize the software. And if you don't want to do it yourself, I've hired Tim on occasion to do certain projects that I don't feel like sitting down and doing myself. He can do them much faster anyway. And I know it'll fit into the trading block system without screwing up something. So sometimes I'll just have him do a project for me. Okay. That's a nice alternative to having to create your own software from scratch.
Yeah. Okay, thank you very much for that. Now I would like to talk a bit about the position sizing, because as we already said, it's crucial and it's a very important part of the trading. So what is your general approach to position sizing?
The general approach, and I would say position sizing in equities is very different than position sizing in futures. So I'm assuming that most of the position sizing questions you would get from your listeners would be in the futures area or foreign exchange type of thing, yes, where you can do a lot of leverage. The simple answer is the higher your position size, the more dangerous you're making your portfolio. That's just absolutely true. If you get down to where you're trading 0.1% of your equity in a particular futures contract, you're going to have a portfolio that's going to be watching paint dry. It's not going to go anywhere, up or down. So more is more dangerous, but more profitable, perhaps. And less is more conservative, less risk, less profitability. More is higher drawdowns or bigger drawdowns. Less would be smaller drawdowns typically. Higher is going to give you faster time out of a drawdown. Low is going to give you longer time to get out of a drawdown once you're in it. And that's kind of the lay of the land. And that being said, where do you start out as a trader? When you have a certain amount of equity, let's say you're starting with $5,000 and you're trying to do a futures portfolio. So you want to diversify a little bit. So you pick, 10 things, let's say, that you're going to trade. And you're trying to decide how much to do of each market. If you make that percent of equity of the $5,000 too small, it'll always tell you to do 0 contracts. You'll never, ever trade. So unfortunately, the new trader is handicapped by the size of the portfolio he's dealing with. Examine it the other way. Let's say the portfolio is $10 million. Well then, you may be able to do 0.1% and actually have some contracts come through. So you're trading off how many things you want to trade. So maybe 10 markets shouldn't be 10. Maybe you want to do 5 markets and do a little bit bigger position per market so that you can actually get 1 contract sizes coming in and you can actually get some experience doing your trading. As you get bigger and more diversified, you have a bigger portfolio. I like for myself initial position risks of around 1% on both risk percent of equity and volatility percent of equity. Volatility to me is a 20-day average true range of that market. Okay. So I take 20 days, take the average true range for each of those days, average it out, turn it into dollars. That's 1 contract in dollars of that particular market. I divide it by the equity. That gives me the percent. And I try to do as many contracts as I can do and keep it within 1% volatility and 1% risk. And then what you do, there's lots of different ways you can go here. You can say, I want to cap it at that all the time. So if the market goes my way, I want to take off contracts to keep my risk and volatility at 1%. Or what I do is I'll say, no, if the market's going my way, I got to give it room to breathe and kind of go my way. So I like to get my ongoing position volatility, because that tends to increase when markets go your way. I only allow it to grow by 0.1%. So I allow it to go from 1% to 1.1%.
Okay.
But on risk, that's the actual price getting farther away from my stops. I allow it to grow to 2.5% per position.
Okay, I understand.
More than that, you're getting pretty racy, because I'm pretty seasoned and I'm pretty good with drawdowns, and I know what I'm doing, and I've got a lot of automation behind me, a lot of research and all that. I got a lot more than a lot of new traders starting out. And you get me too much above 2.5%, it's going to even catch my attention. So I don't know, that's moving pretty quick. Now, here's another thing that happens because of what we said, the lockstep, we had discussion on way back when here in the interview. What I tend to find, trading, I guess 18 markets I think I've got in here now. What I find is that somewhere around 18%, 20%, 15, 16, right in there, when a portfolio as a total gets total risk of all positions up into a larger area, that means you're getting closer to lockstep. Everything is moving in your direction. You're making a lot of money, but as it gets to some point, everything's getting exciting all at the same time. Your total portfolio starts getting a little dangerous. So there, I try to cap it, say 16%, 18%, something like that. And when you start getting over that, I try to just peel off a section of the entire portfolio and take it down a notch to keep the total portfolio risk down. So that's how I deal with risk and volatility. You can add in margin, but it has a very little effect. I used to do in Trendstat days, we used to have margin as a percent of equity as a third position sizing algorithm, but it hardly ever comes into play. And trading blocks that I use now for a lot of stuff doesn't have an easy way to deal with that. I could work on that if I really wanted to. It's not that important, I don't think.
Do you calculate what is the level of your leverage, or you don't care about this once you have a position sizing strategy?
Well, I get leverage as a result of my trading blocks statistics, but it's not something that ever gets to anything I'm worried about, so I don't worry about it.
Okay, I understand. I have another question in topic of position sizing, namely, do you ever increase a losing position?
No.
No. And on the other side, are you maybe pyramiding your position so you're adding to a winning position?
No.
So generally you enter and exit market at one point, at the same amount of contracts or stocks? Or do you, for example, exiting the market partially?
No, I try to do it all at the same time.
Okay.
Well,
okay.
with the exception of, if you have a risk alarm go off because you hit your 2.5% position risk,
right?
And I have 6 contracts and I need to have 5 now, I'll sell one of them off.
Okay.
But that's for risk. It's not because
right.
I'm taking profits. It's not because I'm scaling out of a position or anything. It's because my risk's too high. I'm managing my risk. So any transactions I would take while a position is from start to finish is usually done for volatility or risk purposes.
Okay. Thank you very much for that. It's very interesting. But do you think that in terms of the position size in the book you mentioned from Van Tharp, do you think this is the book which is absolutely covering all an average trader needs, or you think that you would recommend?
No, and then some. It not only covers everything the average trader needs, but everything that Tharpa's ever heard about the topic. So it's a lot of stuff in there.
Okay, I understand. All right. Now I have a few questions which are maybe not so directly so technical, let's say. I need to admit that among the many purely trading aspects, I especially very much admire your lifestyle, because this is also very, very important. Becoming a successful trader is a dream for many, primarily young people. They think that it's so sweet when they, you can imagine how many toys you could buy. You could only afford to buy them, new cars, many houses, exotic journeys, and so on. But we often tend to believe that our happiness is strictly correlated with money. So the more money we have, the more joy in our life. However, there were multiple experiments performed by various researchers, and they show that at some point, having more money is not making us happier. What are your experiences, Tom, here? I mean, as you seem to live so wisely, I see you are enjoying every single day, and I doubt that it's all because of the money you have.
That's correct. Money, to me, buys options. What you do with those options is very, very important. With all the things I've done in my life, people ask, I think in the last year I've had somebody from London ask me to come speak to the London, Technical Analysis Society, and I've had somebody from Toronto say, could you come and speak to our Chartered Financial Analysts meeting or something? And I tell them both the same thing. I traveled all my life. I didn't get to enjoy being home. Now I enjoy being home. We can do the types of things like I'm doing with you, where technology allows us to be in one place. You happen to be a lot later in your day than I am, but we're having a great conversation. We're having fun talking to each other. This is fun. But I've got my setup that I want. I have a comfortable chair I'm sitting in. I have a fast computer that I can deal with. I have air conditioning in a perfect home. I've got a home I designed myself up in the mountains. I'm looking out a 26-mile view of the Mogollon Rim off in the distance. It is gorgeous. We've just rescued a puppy, 6 years old, not so much a puppy, but he's a great dog. He's laying over here next to me on the sofa, watching me because he's not sure whether I'm going to go outside or do something. He wants to make sure he stays close to me. And he's just a lot of fun. And what you find as you get a lot of money and you get a lot of commitments, you start buying those toys. You buy, say, a Ferrari. Ferrari would be great. You can go around the turns real fast. Yeah, well, Ferraris also might break down, and then they got to go into the car dealer, and it has to get fixed, and it costs money. And you can buy that big 6,000 square foot house, which I had back in the day. Had it. I think it was 6,400 square feet. It was worth millions. I had 4 air conditioning zones in the thing.
Wow.
There was some contractor there almost every day fixing something because you got so many things going on in a big house like that there's, this needs painting, that plumbing is broken, this air conditioner's not working, that flooded, so we got to now fix that. We got contractors showing up to cut the grass or to do the landscaping, to do the irrigation. It just gets to the point where you end up not having any time to enjoy yourself. You're managing the toy that you bought.
Right.
So now I have a condo that's, 2350 square foot condo in a gorgeous area of Scottsdale. And it's got probably 600 square feet of beautiful decks that look out at beautiful views over the desert and the mountains. And it's set up perfectly, 2-car garage. I can lock and leave it in about 10 minutes. It takes me no time. I don't have any landscaping. If something needs to be painted on the outside, the condo association does it for me. I don't have to even think of calling a painter. My house up in the mountains does require some time, but I enjoy it because it's peaceful up here. So I go out in the yard every now and again and, fool around with weeds, or I'll go prune some bush someplace, or deal with a tree. And that's just fun to get me out in the sun and the beautiful weather and see the views and watch the elk walk by and give the dog a little chance to be outside. And so that, to me, keeping your life simple in the simple things that you enjoy to do, that to me is the biggest wealth of the world. I mean, if you can do that. My kitchen upstairs from where I'm sitting right now, I just put on a 6-course Italian wine-paired dinner for the Humane Society, which treats the animals here in Payson, takes care of the stray dogs and the cats. And I auctioned it off at a charity event, and someone paid me, or paid the Humane Society actually, $750 to put on a dinner for 6 people. And I did that about 3 weeks ago with my wife's help.
Right.
It was so much fun for me to do it. And it was for such a good cause. And it's something that I can now think about doing because I'm not spending 8 to 10 hours a day running a trading business.
Right.
So that to me, giving back, like being able to cook, which I love to do, being able to do it Italian, since I am Italian by background, that was a lot of fun. And these are the types of experiences in life that are worth far more than the money involved.
Okay, that's very, very, very interesting. I think that many, especially young people, they just think that once they will finally have this big money, then the happiness automatically will appear in their life. Whereas it's not that easy, I guess.
No, it's not that simple. What you find happening is you have to wisely use that money. And I like to use the rule of thumb that if you are purchasing a toy or a thing, whether it's a painting or a house or a car or anything, there's a fixed overhead in maintaining that toy. The painting has to be maybe insured. The painting has to be lit. The painting has to be cleaned periodically. A car has to be fixed. It has to be cleaned. The house has to have, you have house maids come in and clean up the house maybe, or you have to do it yourself. It has to be painted periodically, maybe once every 5 years in Phoenix because of the hot sun. There's going to be fixed overhead. Well, if you have enough toys, some of these people that own 10 homes, I don't know how, that's insane. You can't even, some of the homes that I've seen in the Scottsdale area, people that want to get out of the winter and come down, these people are there 1 week a year. I can't imagine owning a home and dealing with all the maintenance and costs of running a home and then show up once a year.
Right.
That's crazy.
Yes.
That doesn't sound to me like something that I would want to waste money on. I would rather give it to a charity.
Okay. Also, because I know that they called you Mr. Serenity, do you think that having such attitude is also helping to enjoy, for example, retirement in a better way? Absolutely.
When Jack coined that term, Mr. Serenity, I kind of chuckled because Jack, if you know him, at least back then, I don't know, I haven't talked to him recently, was very caffeinated kind of New Yorker. He was, stay up all night and do the book, and he'd just have another cup of coffee and start typing and or start dictating. And his prototypical trader in most of the books was very different than me, because they were all guys geared to the stereotypical, grind out a huge return and be very leveraged, and that's the sexy story of being a trader, make a lot of money. And I'm this guy just plodding along and smile on my face and no stress. And he looked at me and said, he wrote in the book that he gave me something to the effect of, Tom, out of all the traders I've interviewed for 2 books, you're the one I'd most likely like to model myself after, because your life is so much better than all these other guys. And I thought to myself, I thought that was an interesting comment for him to make, having observed so many different traders. I don't have that luxury myself. I've known a lot of traders over the years, but I don't follow them around all day. And so I thought about it, and I thought, really, what I've done is I've taken a business approach to trading. I have designed a business that trades other people's monies, that trades it the way those people want it to be traded. I'm executing a lot of data coming in, decision making, and then outflow of orders and so on. And that's a business approach to trading. And I have employees that I can afford to pay, give great benefits to. And when I put it all together, I'm running a trading business. I'm not a trader that Jack thinks of me as. I'm a businessman whose business happens to be trading other people's monies. And I think a lot of people would be well served to think of that way. Even if they're trading their own portfolio like I'm doing today, the business of trading Tom Basso's personal money by Tom is still a business approach. It's still, I bring in the data, I process it, I ship it out, and I allot my 20 minutes a day, and it's usually between 1 o'clock and say 9 o'clock at night, and that's how my business runs. And it has certain costs. I have to pay certain things. I have hopefully revenues or profits to pay for those things, and that's how the business works.
Right.
But when you do it that way, you're not sitting there obsessed over the next S&P trade you're taking on for 20,000 contracts and worried about stressing out and not being able to sleep at night because you're in a Forex market and you're wondering what the euro is doing at 2 o'clock in the morning. That's the way some traders think they need to be a good trader. I personally think that's a good way to probably last about 10 years and be totally burnt out. You'll never make it long term. Yeah. At 51, the reason I was 50 and at this conference and looking around the room and everybody was gone is they'd moved on to real estate or retired or all the other things that they did. They disappeared. I had lasted longer than everybody else just about. There's a few out there that are still going that I'm friends on Facebook with, but they're getting more and more rare.
Okay. When I read what the expectations among some traders are, I need to admit that I'm at least confused. For example, they believe that they can make 1% return every day or 10% every month, and mostly because they are not capitalized enough. So therefore in order to survive, they have such high goals, taking huge risk. Often they don't think in the long-term perspective. And do you have any advice for those who think like that?
Yes. Most of them frequently, I would say, when I ask the question about the size of their assets and they say, well, I've only got a $4,000 portfolio or I only got $10,000 portfolio. And I ask them, what do you do for your day job? Because you can't live off of $10,000. So what are you doing? Oh, well, I'm a such and such in my father's business, and he's getting older, and I don't really want to take over the business, but we're very successful and all that. And I scratched my head and I said, okay, well, I go back with the emails and I said, if I were you, I would learn as much as I could about trading, do it on a low leverage basis as a sort of an educational process or a hobby. And I would kick it as hard as you could for a few years on your career or your business, and then put away, spend a couple years just living frugally. Don't take wild vacations. Don't buy a big house. Don't do toys. Save every nickel you can and make that portfolio grow faster by saving than by investing for now. Right. Once you get up to the size where you both have an education in how to trade and a comfort level with what your trading strategy is, and you've figured out your money management modules and your risk controls and all those things, now you're ready to kind of graduate into the big leagues a little bit and think about trading a bigger size portfolio, maybe still at the same time managing your business. And then once that portfolio finally generates enough for you to live off of, you can think about closing down the business, selling it, quitting the job, whatever it is that you want to do, and go full-time in trading. That would be a more strategic approach to a person's life than, I like trading, I'm going to make 1% a day and I'm going to be rich next year.
Right. Thank you for that. Very, very, very interesting. So let's say that for someone to survive, he or she needs, let's say, $100,000 per year. What trading capital and let's assume that this person is already well prepared for trading. What trading capital you think you would have to have in order to decide that you can live off trading without being too much worried?
Well, $1 million would be 10%. That would be, if you were thinking you could get 10 to 20%, you got to have $500,000 to $1 million probably, at least. And that doesn't allow a lot of wiggle room for growing the portfolio in terms of loss of capital due to currency devaluation. I mean, the US dollar in 2003 when I retired was worth a lot more than the US dollar is today. I have to spend a lot more dollars to pay for the electricity and taxes and gas for the car and everything else. So I need to grow my portfolio between 2003 and now if I'm still going to be able to provide enough for income. So I definitely think people underestimate how much money they need to fully be operational in a portfolio. Multiple millions would be a whole lot more comfortable.
Right. And also I think that people very often they don't take into consideration inflation factor at all. That's what you said. Especially if your perspective is long-term perspective, you're retired. So $1 million today will not be the same in, let's say, 20, 30 years time.
Well, look at this. I spent 28 years trading other people's money. So that was a big career. I'm now retired 15 years, which is more than half of the time I worked in my business. And I am now, on Sunday, 66 years old, coming up.
Right.
All right. My grandfather on my mother's side lived to 98. So do the math. I am 66, 98. If I lived the same length of time, would be 32 more years. On top of the 15 I've already retired, that would be 47 years of retirement.
Right.
That has to come out of my portfolio because, believe me, Social Security, while I'm on it, does not pay for my lifestyle. And so 47 years of having to try to think about managing money and trading, paying my way with my lifestyle. I only worked 28 years. So you got to have enough money to be able to deal with inflation and loss of purchasing power of the currency you live under. The cost of life just keeps going up and up. And you've got to be able to not only produce enough cash flow, but you also have to increase your portfolio size.
You pay a huge focus on psychology. So my question is why, especially if someone is a systematic trader, because people very often they think that psychology is not that important issue when you are algorithmic trader, because after all, you just follow the strategy. It seems to be so easy, but in fact, psychology, as far as I know, from your perspective, is very, very important factor, actually the number one. So could you please explain a bit more in details how it works?
Yeah, I have to give Van Tharpa the credit here. As he is fond of saying, if you decide as a systematic trader to trade this way versus another way, that's all good and fine. But you can just as easily as a human being turn the computer off, override a trade, do a trade that wasn't part of the systematic trade that you heard some gossip on. You can mess up a systematic system, and I have seen it happen so many times. So mental discipline, mental kind of control of your emotional states, getting very greedy or high, getting very low or depressed, those are all potential pitfalls that you face as a trader where, depending on whether you're systematic or not, doesn't make any difference. If I want to not go ahead and show up between 1 o'clock and 9 o'clock and run my trading block software and put my orders in, I have the ability to do that because I'm a human being.
Yeah.
Well, if I do it, it's not following my strategy, and I might miss a trade. I might have too much risk in a trade or not peel off a position when I should have. And all of that is going to help lead to a failure of my trading strategy to do what it can do. So psychology, mental is the most important thing. Money management and position sizing and portfolio management and all that is second most important. And last but least important is where to buy and sell.
Right. Okay. So, which is actually the opposite what the average beginners are doing.
Which is why they're beginners and they haven't figured it out yet.
Yeah. And do you think that, or maybe you are having any special approach how you work on the psychological aspects? You train yourself somehow?
Yeah, there's different approaches to that and different ways of thinking at it. I know Tharpa has had a lot of thoughts on the topic, and he's published a few things. Mark Douglas has done some mental books on trading. There's been a number of others. If you put in investment psychology or investment mental process, you'll get a number of different great authors. And Charles Faulkner comes to mind also. I've read all that stuff, and a lot of it's very interesting, and it gets you thinking. But in the end, I believe you yourself, the trader, has to know yourself well enough so that you know what buttons the market wants to push on you, and where you find yourself getting greedy or getting yourself depressed or getting yourself frustrated or nervous or all those types of things. And I think realizing you're that way and then asking yourself, what do I have to do to create more discipline within my life, more ease in waking up and going through my day? Are you working out enough? Are you caffeinated? I'm having a decaffeinated peach tea right now. I had no caffeine for morning. I very rarely will have an iced tea when I'm out at lunch someplace. I don't have any caffeine late in the day. For me, having sort of an energetic type of childhood and an energetic style of getting things done fast, if you caffeinate me, I'm just going way too fast. I don't even realize I'm doing stuff. My brain is processing stuff on such a fast scale, I can't even realize that I'm doing it. And I'm onto this, and I'm onto that, and I'm over here, and I'm up there, and my mind is not focused on any one thing. I'm getting a lot of stuff done, and it just drives me nuts. So I found when I was in about 26 years old or so, I got rid of coffee. And I just do decaf or something else, water, some lemon flavored drink, something like that. And when I did that, it was hard for a day or two because you have the typical withdrawal. You have the pain in your forehead and you feel like you're dragging. But then you start realizing, hey, wait a second, I'm not dragging, I'm peaceful. This is the way I am all the time. Now I can think of things. And I can actually be cool-headed, and I don't have to get frazzled when a trade doesn't go my way. I can see it in a different light. And I think being in good shape is another thing. Working out. Yesterday I did a huge workout, and then I went out and played golf for 18 holes in the heat at 66 years old. And my body fat now is running about 15%. 18 to 21 would be normal for a male my age, and I'm at 15.
Okay.
So you work out. Well, what does working out do for you? It gives your body the ability to take on stress on occasion, like a bad trade or like a more exciting situation, a medical situation or a family situation, or you got your house is without electricity and your food in the refrigerator is about ready to go bad. How do you solve that? Stress. When you're in good physical condition, it relaxes you because your heart is beating less frequently. Everything is more relaxed because you have the strength to handle that without any issue. And those types of things, people need to examine other parts of their lives and how it affects their trading life. And I don't think a lot of people do that. The concept of get up in the morning, have big pot of coffee, get yourself jacked up, and then trade your brains out all day, and then go to sleep just physically exhausted, no workout, and trying to get off the caffeine to get a good night's sleep. I mean, some people are up there in the middle of the night having coffee. I mean, that's just a recipe for disaster. You're never going to get that deep, quality sleep that you need to repair your body, to repair your brain cells. And I think that is a lot more important than people give it credit for. And so a lot of these types of topics are useful in trying to create that sort of serenity that Jack saw in me.
Yeah, I think that maybe also, especially young people, they think that when they are young, they are made of steel. So they are not thinking what will be in, 3-4 decades. So maybe even if they will become rich, but they don't think in which state they will be, their body. So this is also very
50,
important.
it doesn't do you much good. Yeah, it's like you worked really hard for kind of nothing.
Yeah. Thank you very much for that, Tom. I've got actually the last question on my list here, which is, what are the biggest lessons you learned through trading?
Wow. All right. Let's see. Biggest lessons I learned through trading. One of them would have been caffeine.
Okay.
Getting rid of that helped me just be a lot more peaceful in all my life, not just trading. Trading also taught me a lot about observing myself. If you were to give yourself, let's say you're going to do a talk at some panel or, talk to the futures industry, and you wanted to practice that speech in front of a mirror, you would be observing yourself in the mirror giving a speech. So part of your brain would be looking at that mirror, and the other part would be actually executing, moving your mouth and having voice come out of it and giving your speech. So you would be doing sort of what I would call a closed loop of, I'm saying a word, I am also watching myself saying that word, and then in my brain someplace I'm trying to decide, does that look good or not? Did I say the right word or not? There's a kind of a control loop going around the circle. And as I got more good at trying to observe myself, be greedy, be frustrated, be nervous, be all these things that you are when you trade, I think trading gave me a lot of lessons there in how to deal with my own brain and my own mind. So that was a useful thing. Trading also taught me a lot about leverage and how more leverage leads to more swings of emotion. And that dialing it in is very important. Dialing it in low enough so that you can make a decent return, but not too high, which gives you too much excitement. Another lesson to be learned was discipline. The silver trade that you mentioned that I missed when my parents came to visit was a big lesson in, wow, that would have been my biggest trade of the year. And I was playing tour guide in St. Louis for my mom and dad, and I got to it the week after and said, well, it's too late. The trade's already underway and I can't get in late. So I missed it. And I vowed after that never to miss a trade again, and I haven't. That's one of my main lessons that I learned there, and I followed it ever since. That's pretty much the ones that come to mind right off.
That's very, very, very interesting. Thank you very much for that, Tom. Is there anything else you would like to add before we will finish this interview?
Well, I would add that I get a lot of emails, which I'm happy to receive. Tom@trendstat.com. I kept my old email address so people could get in touch with me. And I'm happy to answer simple questions in email form. And I use the email to reply right back in the email with the answer. And I try to do it quickly. But I've found myself this last fall answering so many emails each day that I was thinking, I'm saying the same things over and over again. Everybody asks me the same questions. Just like the questions you've asked me, I've probably been asked at least once or more before, someplace. I mean, because my life is now getting to be 40 years of trading, and I'll have friends ask me these questions. I'll have people in the industry, new traders, whatever. And my wife and I decided to do this website, and it's going to be announced if you follow my Twitter, which I think is @Basso, and I think I'm also on Facebook, and feel free to friend me there, Tom Basso. And I'll announce it there, but in about a month or two, I'll have a site that has all the recommendations that I've ever thought of for books. I'll have videos available for some of them for purchase, some of them for just looking at, frequently asked questions that a lot of people have asked me over the years. And our goal is to try to get it all in one place so that it is essentially Tom Basso's retirement website.
Okay.
And instead of having to send me an email, rather than ask me one single question and have me give you one single answer, you can then, as a trader, go onto the website and have the ability to go a lot of different directions with information to help your trading knowledge and trading success and development of your trading strategies and everything that you will want to do. So give me about another month or two, and we hope to go live, and I'll certainly announce it through all the usual sources, the Twitters and the Facebooks. So if you're following me there, you'll know when it goes live, because I'll mention it a number of times to make sure people are aware of it. And hopefully that'll be helpful to the industry, and I maybe get a few less emails.
I'm pretty sure it will be very helpful. I will link all the information on my website, and also once your website will be ready, I will also inform. So I think it will be absolutely a great source of information. So indeed, it will help you maybe to have less emails.
And I got one other thing that I would that you haven't asked me, which I'm surprised, because most people always ask me, "What's the story behind this enjoy the ride?"
I was about to ask it, but I was thinking that actually everyone is asking you this question. Actually, whichever all the podcasts I heard with you, everyone was asking about this. But okay,
right.
Yeah, please go ahead.
enjoy the ride. One day I was sitting there and I was publishing my hedging buy and sell signals for my relatives who were trying to hedge their stock or mutual fund portfolios. And they were neophytes in trading, and they didn't really want to be traders. So I thought, all right, they're friends of mine on Facebook. So what I'll do is I'll go ahead and say, okay, the trend is down now, so I'm putting the hedges on, and then my various relatives could help themselves and do whatever they wanted with it, because I don't manage my relatives' money. And so that led to people finding out that were old trading friends of mine in the industry that I was doing that, and they got curious about which way I was leaning. And somebody said, "Why don't you do it over on Twitter and then kick it over to Facebook?" So I did that. Well, one time when I did this, I'd just gone through a whipsaw. So I'd put on a hedge and then quickly took it back off, and of course my stocks were shooting up. I was happy. And but I took a loss on the hedge trade, and I thought, well, if somebody were to actually have done that hedge trade, they're probably licking their wounds on that, how quick it was and how severe it was. And so I said, well, yeah, now the direction's up, the stocks are moving, put the risk on, let the horses run, and enjoy the ride.
Yeah.
And I thought to myself, that's interesting, enjoy the ride. That's kind of what it is when you're trading. So I went ahead and said that again. A couple days later, and then I did it again, and then I ran out of characters on Twitter because they were limited to 144 or whatever it is, 140, and so I put ETR, and I just capital ETR, and I had somebody who I don't even know who's following me on Twitter. I'm out golfing. I come back and I got a question on Twitter. What does ETR mean? And another guy who's following me says, "Enjoy the ride, you idiot." Like, people are already have locked me into this enjoy the ride thing, and I didn't even realize that had happened. And so one thing's led to another. Now I just always, whenever I'm doing something, I throw enjoy the ride at the end of it, because it's kind of enjoy the ride of life, enjoy the ride of the markets, enjoy the ride of trading. I mean, you're not getting out of this alive. You might as well enjoy the ride, right? And so that's the story behind that.
Yeah, that's very, very interesting. Yes. I often see that on Twitter you're also using this enjoy the ride. So this is your trademark.
It's not trademark, but it's people have associated with me. Every now and again I'll get a Facebook or a Twitter, hey Tom Basso, you should see this, and it'll be something like a carnival ride with a little 4'5" or 4'8" or whatever, a little line, must be this tall to enjoy the ride. And other people will say there'd be something about here's where you rent your bicycles, enjoy your ride. And so there's all these commercial applications to enjoy the ride that people see signs, they take pictures, and they send them to me. I've got a collection of them now. It's kind of humorous. The people actually associate that with me, but it's been a fun ride so far.
But although I haven't asked about the enjoy the ride, I have asked about the Mr. Serenity, because that's another term which is so well connected to you.
Yeah, I'm still fairly low-keyed and relaxed in my life. I do a lot of things, but I try to not overdo. Like one year I did 2 charity dinners that I mentioned to you earlier, and that was a little bit tough on me. I'm getting a little older. It's a pretty demanding day and a half getting ready for it and going through 6 courses of Italian food made from scratch. So, I'm pacing myself, trying to play golf when I can play golf. And like today, I won't play any golf, and I won't play tomorrow. But then on the weekend, I've got the club championship, so I'll play Saturday and Sunday. And so I try to be prepared and get ready for it. I might hit little balls, but I try to do that. But then I try to get a workout in at the same time, and I try to help you with your podcast, the interview. And I'll still run my orders this afternoon, and I've still got to go walk the dog, and I'll make lunch for myself because my wife is out playing golf today. So I try to. Each day is different. I try to keep them relaxed. I try not to overschedule, and I try not to travel any more than I have to. Mostly to see family these days. Occasionally for a vacation, if my wife can convince me to go someplace. So, but it's a good life and a very serene one.
Yeah. Thank you, Tom, very much for your time, for your effort. I do really appreciate it. It was really big honor and pleasure to spend this time with you. So I wish you all the best and enjoy the ride.
Very good. It was my pleasure, and thank you for the interview. I think you did a great job, and it was a lot of fun.
Thank you very much. Bye-bye.
Bye-bye.